So, a pretty frequent question I get when people are starting to think about selling their house is what are the financial implications of doing so? And what are some considerations I should be making as I come into what is oftentimes a very unique liquidity event and an opportunity to really make sure that we're making smart financial decisions and putting all of those puzzle pieces together correctly. In the United States, most households have their assets in really two buckets. Um, a lot of times it's your retirement account associated with your work and the equity that you're building or have built in your home. That isn't because there's necessarily anything magical about either one of those asset classes, other than they have some tax advantages to them, and they are both a forced saving mechanism. And what I mean by that. So when you are working and you're contributing to your work-related 401k, oftentimes you're not seeing that money, right? It's going right into your 401k, not hitting your checking account, not giving you that opportunity to scratch that itch and spend that money. It's really forced saving, which is a great thing. The same is true when it comes to your home equity. So if you're making a monthly payment, you are paying down that debt every month and adding to the equity in it and just moving it from one side of the ledger to the other. And oftentimes that's why we end up with these two asset classes as our biggest assets as we approach retirement. A common question that I get from people as they're getting ready to sell their house is, what are the tax implications of doing this? Am I going to get whacked by capital gains or any sort of other tax related to selling my house? And the beautiful thing is, in the United States, we have a really healthy tax exemption for the gain associated with selling. So if you're a married couple, that threshold is $500,000 of gain. Not $500,000 of sell price, but $500,000 of gain. So, for example, if you purchased a house years ago for 300,000, you sell it for 850,000, all but 50,000 of that gain is going to be completely tax free. So if you sold it for 800 and bought it for 300, all of the $500,000 of gain is tax free. Included in that 300, you can add things like home improvement. So if you put a new roof on your house, put new siding on, new windows, or even spent money to paint your house, you can add those home improvements to the overall basis. So again, for example, you purchased a house for 300,000, you put $50,000 of improvements into it. Now your new basis is 350,000. So in that same example, you sell it for 850,000. You have $500,000 of gain, of which if you're a married couple and have met all of the rules, you have a 500,000 tax-free gain on the sale of that house. And again, this is a really unique time to actually take possession of what otherwise can be an illiquid part of your overall financial picture. And so it's time to really sit with a professional and say, what is the best thing to be doing with that equity? Maybe the right thing is to roll it back into your next home, which a lot of people end up doing. But again, allowing us that opportunity to really sit down and figure out what the best thing is for you, it might make sense to pay off high interest credit card debt. If you're close to retirement and feel like you're behind, maybe it's an opportunity to take some of those proceeds out of real estate and put it into a retirement account that then you can start to generate retirement income from. There are some hidden costs when it comes to selling. Things like closing costs, staging, moving expenses. They can all start to erode, what that ultimate check that you're going to get is. That's not to say that any of these things are necessarily bad. Staging, for example, can more than pay for itself. But it is smart just to think about the hidden costs that do come along with selling your house and discuss with those professionals, are there ways to minimize those costs or maximize the return on those costs. And integrating, again, this unique time to actually take possession of some funds is a great opportunity to make sure that that home equity aligns with what your long-term goals are. So for a couple that's approaching retirement, for example, you might be in a situation where you're downsizing and the amount you're getting in gain from selling your house that you've lived in for the past 20 years and raised your family in, You don't need all of those funds to pay for the down payment on a house that you're downsizing to. So again, might this be a great opportunity for you to take some of that equity out, put it into another vehicle that is one, more liquid, and two, better aligns with that retirement goal. The flip side is if you're a young couple and you're moving from that starter home into your forever home, is it the right time to think about maybe paying off debt that is less efficient than what your mortgage is? So for example, if you carry credit card debt that's got 20+% interest that you're paying on, and you can borrow money at 6 or 7% in today's market a for a mortgage, I'm inclined to say, well, let's pay off that credit card debt and save ourselves a lot of interest payment over time. And another thing that we really need to be thinking about is this an opportunity to add to our liquidity or emergency funds? What I hate is seeing people who have done a great job saving, but done it in only those two asset classes, which are generally illiquid until you hit certain ages. So maybe you've done a good job saving, but all of that is in your 401k plan. If you're not 59 and a half, you get penalties if you start to access those funds. The same thing with home equity. Oftentimes that is at an interest rate that isn't palatable to be borrowing against, and so you're stuck. So if you do have an equity, if you do run into some equity when you do sell your house, maybe it's time to put some money away. So if you do lose your job or have some unexpected expenses, you can tap into something that's much more liquid than the equity in your home or the retirement accounts that you have. And again, always a great time to be thinking about debt and cash flow. And one of the things that I really want people to think about is when they do sell their house and move into that next house, what are the new monthly payments going to look like? And can I actually afford to buy this next piece of property? A good rule of thumb is not to have your monthly payments for your home be more than around 30% of your overall monthly budget. A lot of times people run into a situation where you know, the term house poor comes into mind. What that means is, yeah, you're making good money, but a lot of it is going to pay for your home, and what you're left with after that is not enough to live the lifestyle that you're after. So again, just a really opportune time, a unique time to be thinking about what are my other debts and what does my cash flow look like going forward. And then again, just really sitting down and thinking about what are the risks that I'm okay taking? What are the return expectations that I have based on various asset classes? And what is my time horizon? How close am I to retirement? And do I need to be doing things that maybe can add to my retirement income rather than just plowing all of that equity back into your house or any liquid asset? And having a discussion with a certified financial planner is a great start. We've got the knowledge, the expertise, and the experience to help you identify what are those goals, what is that time horizon, what is that risk tolerance for you, and how do all of those puzzle pieces fit together to put yourself in the best spot for future financial success. I hope this is helpful as you think about selling your house. And if you have any questions, feel free to reach out.